This question tests students' knowledge of the consolidation models recognized under U.S. GAAP. The key phrase is recognized in U.S. GAAP. Students should distinguish between consolidation models, which determine whether an entity should be consolidated, and accounting methods for investments, such as the equity method or cost method. Under U.S. GAAP, ASC 810, consolidation, there are two primary consolidation models. Voting interest model, applied when control is obtained through ownership of a majority of the voting rights, generally more than 50%. Variable interest entity, VE model, applied when control exists through economic interests or contractual arrangements, even without majority voting ownership. The question is testing whether students can identify these two official models. A. Equity model and cost model. Incorrect. The equity method and cost/fair value method are investment accounting methods, not consolidation models. They are used when the investor does not consolidate the investee. B. Variable interest entity model and voting interest model. Correct. U.S. GAAP recognizes two consolidation models. Voting interest model, based primarily on majority voting ownership. Variable interest entity, VIE model, based on control through variable interests rather than voting rights. These are the two official models used to determine whether consolidation is required. C. Parent-subsidiary model and joint venture model. Incorrect. Although parent-subsidiary relationships involve consolidation, parent-subsidiary model and joint venture model are not the two recognized consolidation models under U.S. GAAP. D. Full consolidation model and partial consolidation model. Incorrect. These are not formal consolidation models recognized by U.S. GAAP. U.S. GAAP does not classify consolidation into full and partial models. Correct answer: B. Variable interest entity model and voting interest model. A useful memory aid is: vote or variable equals consolidate. If control exists through voting rights, use the voting interest model. If control exists through economic exposure rather than voting rights, use the variable interest entity, VIE model. Therefore, the correct answer is B. Variable interest entity model and voting interest model. This question tests students' understanding of the treatment of intracompany, intercompany transactions in consolidated financial statements under U.S. GAAP. The key phrase is sold goods to its wholly owned subsidiary and preparing consolidated financial statements. Under U.S. GAAP, consolidated financial statements present the parent company and its subsidiaries as a single economic entity. Transactions occurring within the group, for example, sales between the parent and subsidiary, intercompany receivables and payables, loans, dividends and profits, do not represent transactions with outside parties. Therefore, they must be eliminated during the consolidation process to prevent revenues, expenses, assets, and liabilities from being overstated. The question is testing a fundamental consolidation principle. Intercompany transactions should not appear in the consolidated financial statements. Reported in the notes of the financial statements. Incorrect. Although some related party disclosures may be required in certain circumstances, ordinary intracompany transactions are eliminated during consolidation, not simply disclosed in the notes. B. Highlighted as contingent liabilities. Incorrect. A sale of goods between a parent and its subsidiary does not create a contingent liability. Therefore, this treatment is inappropriate. C. Eliminated to avoid double counting. Correct. This is a fundamental rule of consolidation. Intercompany sales, purchases, receivables, payables, and any unrealized intercompany profits are eliminated so that the consolidated financial statements reflect only transactions with external parties. For example, parent sales equals $100, 000 subsidiary purchases equals $100,000. In consolidation, sales minus $100, 000 cost of sales minus $100, 000. Thus, internal transactions do not overstate group revenue or expenses. D. Consolidated using the equity method. Incorrect. The equity method is used for investments where the investor has significant influence but not control, generally ownership of 20% to 50%. It is not used to eliminate intracompany transactions within a consolidated group. Correct answer, C. Eliminated to avoid double counting. Exam tip. When preparing consolidated financial statements, think of the parent and subsidiary as one single company. Therefore, all intracompany transactions must be eliminated, including intercompany sales and purchases, intercompany receivables and payables, intercompany loans and interest, intercompany dividends, unrealized profits remaining in inventory or fixed assets. A useful memory aid is: inside the group equals eliminate, outside the group equals report. Since the sale occurred between Company X and its wholly owned subsidiary, the transaction is eliminated to avoid double counting, making C the correct answer. This question tests students' understanding of the integrated reporting framework, specifically the 6 capitals that organizations use to create value over time. The key phrase is the system used to accumulate and analyze the driving data. Students should focus on the system and knowledge-based infrastructure, not the data itself or the employees operating it. In integrated reporting, assets such as software, databases, algorithms, information systems, patents, and organizational knowledge are generally classified as intellectual capital. A common exam trap is to confuse human capital, employees' skills and experience, with intellectual capital, organizational knowledge, systems, and intellectual property. A. Human capital. Incorrect. Human capital refers to the skills, competencies, experience, motivation, and capabilities of employees and management. Although engineers and data scientists contribute to the system, the question asks about the system used to collect and analyze data, not the people. B. Intellectual capital. Correct. Intellectual capital includes organizational knowledge, proprietary software, databases, information systems, algorithms, intellectual property, and technological processes that create future value. The driving data collection and analysis system is a knowledge-based technological asset, making intellectual capital the correct classification. C. Natural capital. Incorrect. Natural capital refers to environmental resources, such as water, land, minerals, biodiversity, and ecosystems. The driving data system has no direct connection to natural resources. D. Manufactural capital. Incorrect. Manufactured capital includes physical manufactured assets, such as factories, machinery, vehicles, and production facilities. Although the electric vehicles themselves are manufactured capital, the data analysis system is not. Correct answer, B. Intellectual capital. A useful memory aid is: knowledge and systems equals intellectual capital. Since the question refers to a system that collects and analyzes customer driving data to support future autonomous technology, it represents organizational knowledge and technology, making B. Intellectual capital the correct answer.